I remember my grandma's first-hand experience about the time when she received a massive retirement bonus from her job. Over $250,000. And this was back in 1995, so you know that money was worth a lot more than it is now. She was thrilled, and then she became convinced to invest that money in stocks. So she did. All of it. Every single penny was given to a company to invest in stocks. And guess what? Like a magic trick from your favorite magician, that money went poof. It disappeared without a trace. Needless to say, she was devastated. But the good news is, this book will help many avoid making similar mistakes, and hopefully, this video will too. The truth is, on average, every 3 to 5 years, a bear market happens. Market crashes, or bear markets, cause a decline in the economy, and so prices drop about 20 to 60%. That's when words like recession and Great Depression gets thrown around to describe economic decline. And if you watch the news, you're likely to feel panic, fall into pessimism, and start to wonder, will the market ever recover? Well, outside of all the doom and gloom, there are a few who see this crash as a time for us to invest more money at lesser cost. These brilliant minds know that the crash is one of the greatest opportunities in our lifetime to move up the ladder. You know why? Because everything goes on sale when the economy drops. While people and shop owners are caught by surprise, completely unprepared, and then forced to sell their luxury homes and Lamborghinis at 50% off, they are capitalizing on these real estate and stock investments at incredibly low prices. One of the greatest investors of the last century said, "The best opportunities come in times of maximum pessimism." Tip number 1 is, the best time for you to invest is during a crash. So, I started to realize that the greatest danger to our financial health isn't a market crash. It's being out of the market. And since you cannot accurately predict the rise and falls of the market, one of the most fundamental rules for achieving long-term financial success is that you get in the market and stay in it for the long run. But then that begs the question, which stock investment should you make? Well, this book recommends a solution that allows us to make money almost entirely on autopilot. The solution is for you to buy and hold onto every stock in an index such as the S&P 500. This includes companies like Apple, Google, Amazon, and Facebook, which, by the way, are the 4 businesses that are in a race to become the first trillion-dollar company. Also, an index fund protects investors against high transaction costs and taxes due to making fewer trades. This is a strategy recommended by Dalio, Swenson, Warren Buffett, and Jack Bogle. Tip number 2 is, the safest and securest investment you can make is on index funds. Now let's look at a great example from the book. Imagine that 2 friends, Joe and Bob, decide to invest $300 a month. Joe gets started at age 19, keeps going for 8 years, and then stops adding to this pot at age 27. In all, he saved a total of $28,800. Joe's money then compounds at a rate of 10% a year, which is roughly the rate of return of the US stock market over the last century. By the time he retires at age 65, how much does he have? The answer is $1,863,287. His small $28,800 investment has grown to nearly a $2 million investment. So let's look at his friend Bob. Bob gets off to a slower start and begins investing the same exact amount, $300 a month, at the age of 27. He's a disciplined guy and keeps on investing $300 a month until he's 65, a period of 39 years. His money also compounds at 10% a year. The result? When he retires at age 65, he's sitting on a nest egg of $1,589,733. So, if we step back for a moment, we can see that Bob invested a total of $140,000, which is almost 5 times more than the $28,800 that Joe invested. Yet Joe has ended up with an extra $273,554, even though Joe never invested a dime after the age of 27. So because Joe started earlier, the compound interest he earns on his investment brings way more value to his account. The point of the story is that compound interest is a force that can catapult you into a life of total financial freedom. Tip number 3 is, you don't need a lot of money to be wealthy. You need time. Today's winners could be tomorrow's losers. Don't let that be you. One of the biggest mistakes you can make when getting into financial investments is relying on a financial broker to manage your portfolio. First and foremost, they are loyal to the shareholders and the big money commissions they make by putting you on expensive, actively managed funds. You might end up with additional fees and taxes that will destroy your possibility of generating a passive income stream. Like the story about my grandma, these companies are incentivized to create bigger profits for themselves. This is a zero-sum game that you don't want to play. Give your trust to someone qualified who has your best interest in mind. Registered investment advisors, like doctors and lawyers, have a fiduciary duty and a legal obligation to act in your best interest at all times. Tip number 4 is, your financial broker will make you broker. The thing is, so many adults my age are not investing. According to the book, about 50% of millennials distrust the financial markets and keep a great amount of their savings in cash. If you want to be certain that you'll never lose your money in the financial markets, then you can keep your savings in cash. But then you'll also never stand a chance of achieving financial freedom through investing. As Warren Buffett says, we pay a high price for certainty. What he could have added was that we also pay a high price for fear. If you live in unwarranted fear, you've lost the game before it even begins. How can we achieve anything if we're too scared to take a risk? You have to focus on what you can control, not on what you can't. When you become unshakable, you have unwavering confidence even amidst the storm. You are no longer trapped by circumstances or by fear of the coming crash. At the same time, you don't want to be too confident. That can lead to making bad decisions, such as relying heavily on one stock, like Apple, or trying to predict the market corrections and fluctuations. Remain clear-headed and use logic over emotions. Act on the basis of knowledge. Tip number 5 is, don't invest emotionally in your financial investments. And these are the 5 passive income tips I learned from reading Unshakeable by Tony Robbins. If you know someone who is not a financial genius and may benefit from any of these 5 tips in this video, then please share this video. And of course, if you like the video, leave a like. If you like the channel, please subscribe.